Hi, folks. Welcome to your world with Prakash Kapila. Today, we have a very important show for you. And in this show, we're going to talk about, again, a financial stock, a financial implications on a stock and how in one day, $35 billion have been vanished out of the market. In one day, $35 billion have been sold off in the market. That means they just sold it at a high rate, whatever rate. I mean, you name how much you want to buy, I'll give it to you. I'll give it to you like that. Fire sale happened, and the total amount of money of that fire sale on one particular day was $35 billion. $35 billion. And this happened on March 27th, very recently. So to give you a perspective, this is reminding us of the GameStop, where in one day, the whole company got bankrupt, like $10 billion worth of company. There is one hedge fund company of $10 billion, and it just vanished. $10 billion vanished. Now this is $35 billion, so 3 times more, 3.5 times more. So who are the players here? What happened, and how did this go about? Is what we're going to look around, look around, and come to grips with. Okay, so first thing first, there are players, there are buyers and there are sellers. Stock market is only about buying and selling, okay? So now in this buying and selling, the company, there are so many players. And like we watched the last time, the billionaires and the millionaires club are segregated. So the billionaires club are the high net worth individuals, the high net worth companies, they float high net worth companies that the prime brokerages are going to help them. So what is a prime brokerage? Prime brokerage is like a bank for hedge fund. See, when you want to buy a car, what do? You go to bank and you say, you go to a dealer and you say, I want to buy so much. The dealer will ask the bank, okay, this guy is thinking of buying it. Can you think that he can buy or not? And then the bank says, okay, I will lend that person this much money with this much interest, this much, so on and so forth. So the bank is in between the buyer and the seller all the time. Whichever thing, whatever you want to buy, there is a bank in between. So for a very high hedge fund companies, the banks are the prime brokerages. So the prime brokerages have the strength of the market. They manage the dark pools. They are part of those dark pools. They are part of different exchanges. They have the money, they have the investors, they have the wherewithal of fulfilling the desires of a very high hedge fund. So in all this setup, around say 2010 or 8, something like that, there was a law that was passed by the Congress that I don't really remember the exact year, but the law says that a private companies need not give to the SEC the regular reporting that other hedge funds and financial companies have to give. So what will happen is that these, the thought behind that was these the private companies are small holding. They don't manage the money of others. So they don't come into the ambit of profit making. They're more like managing the companies for long years, like 50 years, 60 years, like that. There are a few private fund companies that do that. say, for example, Ford Motor Company is the household of Ford, maybe one such private thing, or say Tatas or Birlas or something like that. So there are few holding companies, private companies that have a substantial stock in a particular company, and they maintain it for a long time. So those kind of companies are exempted from. Exempted means they don't have to give the quarterly reports to all the to the Securities and Exchange Commission. So any stock that is in US, right? Any stock that is trading in US has to is under the ambit of the SEC. So SEC can ask for all the details, and there are a lot of reports that these guys have to submit. So Archegos Capital was founded by Bill Wong. This Bill Wong was part of the Tiger Management. Who is this Tiger Management? Tiger Management is like almost like Warren Buffett kind of thing, where in span of 15 years, they converted some $5 million into 20 billion. So in span of 15 years, that's a humongous growth. So 1 billion is 1,000 million. So for 5 million to go to 20 billion, it's like so many times, 200 into 20, like 4,000. Yeah, 4,000 times or 5,000 times the money has been multiplied in just 10 years, 10, 15 years. So the Bill Wong was managing the Asia division of this Tiger Management. And he was charged with insider trading. Insider trading means a crime, a simple thing. It's a criminal offense to know about non-public information and trade on it. So by either bribing people who are in the company, or by not following the rules and regulations, you get some information inside of the company because of your position or something, or you bribe someone. So all those things are considered as criminal. So Bill Wong, around 2012, he was charged with insider trading. So when someone gets charged with insider trading, that's it, game over. You are not supposed to interact with financial institutions. No financial institution is going to, support you or help you or do anything with it. So in span of like, he just waited for 2 more years and started the company called Archegos Capital. Around 2013 or something, he started Archegos Capital. The initial money of that capital was $200 million. $200 million was the initial capital of that company. So from around 2021, the capital base of this company grew from 200 million to 10 billion. 200 million to 10 billion. This many times, it just rapidly made money. So how did it make money is a big question. And most probably, he was very smart. He did all smart things and whatnot. So there are few synthetic options that this person has done. What are this? What is that synthetic option? Synthetic means something that's not real. Synthetic means artificial, right? So what is this artificial option? Artificial option is for a option, you need to have an asset. Okay, whether you're buying a put, you're saying put, call, or between both of them a butterfly or whatever. So all those things require that you need a stock. based on that. So you have a stock and you're buying a put. Put means the stock is going to fall. Call means the stock is going to rise. So you're either buying a put or a call or verticals or butterflies or any of those things based on the stock that you have. So in synthetic stock, in a synthetic option, what happens is you don't have the stock. So what you're doing is what the actual thing happened was it's called total return swap. What is this total return swap? There is a chart there. You can see that. So in that, swap means exchange, right? Someone is exchanging something for something. I'm giving you something and you have to give me something. So what is the total return swap? Total return swap is basically someone is saying to the bank that I'm going to give you this much amount of money. In return, you give me the stock, the returns on the stock. So what are the returns on the stock? It could be your stock split. It could be your increase in stock price. It could be your dividends. It could be your returns over a period of time. So all the swaps, there is something called notional. Notional means it is a, believe me or not, it is a imaginative number, as simple as that. So the imaginative number for one swap would be 1 million. So if I buy 200 stocks, it will be 200 swaps. It will be like 200 million is the notional. So swaps always go on a 1 million notional. Okay. In 1 million notional, the banks, see, there are four banks in this case. One is Credit Suisse, second one Nomura, third one Goldman Sachs, Morgan Stanley. These four are the big banks, and Wells Fargo, of course. Wells Fargo will always be there. So Wells Fargo, Credit Suisse, Nomura, Goldman Sachs, and Morgan Stanley. These five banks have become a prime broker for this particular ArchegosCapital. What they said is, okay, each one of them interacted with this guy without knowing the other guy. I mean, it's market, right? Anybody can buy from anybody and all those. So that information is not known because all these guys are prime brokers and they maintain a dark pool. So what is happening in dark pool? Who is buying and who is selling is not known. So with all these five big banks, he traded with each one of them individually. And nobody knew how much this ArchegosCapital was leveraging. So leveraging means if I have one unit, I can buy 20 units. Then the leverage is 1:20. So imagine for $1 million, how much leverage it would have happened. So divide 1 million by 20. Then you got, say, 100,000 by 2, right? 100,000 by 2 is like 50,000. So for $50,000, you could actually trade on a $1 million stock. That is the leverage the ArchegosCapital did. So with each of these banks, the leverage was very high, 10, 20 times the price. So total interest swap. So what total interest swap is based on an index. So what did the index have? Index means combination of stocks. So the index of ArchegosCapital was Tencent, Baidu, GSX, IQYI. It's a whip shop, vaping shop, I think, and Viacom. The other one is CBS, CBS, Viacom, and Baidu, Tencent, CBS, Viacom. I don't remember the other US company name. So there are like 5 stocks, right? All these 5 stocks were part of the index. And this index was having the total return swap. So all the money that these stocks gives out, if the ArchegosCapital gets it. So in terms of dividends, in terms of returns, in terms of any warrants, all those stuff, right? Wherever the money is given out to the shareholders, that money is what the ArchegosCapital got. So in span of just 1 year, almost all these index stocks were doubled, more than double. Viacom and Tencent, Baidu, all of them are US shares. Viacom, Tencent, Baidu are all US shares, whereas IQYI, Big Shop, and other things were there in China. These Chinese tech stocks were also traded in US. So that's how he created an index out of it. And the US company started giving the total return swaps. So for total return swap, what happens is the company that is on the other side. So this is ArchegosCapital, and this is another company, Prime Broker. So Prime Broker says, okay, I will buy for you those stocks and keep it with me, and you pay me fixed price. That fixed price, you give me some price based on, say, LIBOR, or based on, say, US 10. Say US 10 years is like 3%, 1.7%. 1.7%. All right. So then the company could say, hey, give me double that of 1.7%, which is like 3.5%. So I'll give you $1 million for 3.5% interest is what it comes down. So this guy is going to give that much for the company. So out of 1 million, you are giving 3.5%, which is like $35,000, right? Or if it, yeah, 35,000 to 40,000. And the company, what it says is, for these stocks that you have, we are going to buy all these stocks and keep it with us and give you the dividends once these companies pay those dividends. So if the company pays those dividends like 20% or 10%, every company does that, right? So when the company pays those dividends, that this guy is going to get the dividends, maybe 10% or 15%, or if the stock prices increases by 100%, then the change of the money is given to this guy. So with just $35 or $40,000 he gives to the bank, he gets $1 million worth of the stock and all the money associated with that 1 million. So how much they have just doubled in just 1 year? They doubled. So when the stock was going up, this guy was getting money. Everything was hunky-dory, everything was good. But in this dark pool, this guy and this guy, all these guys were playing with the same person. So with all these people, he started negotiating. When the person is getting a lot of money, there will be other parties that will try to insure you. Okay, say you are having the debt for this guy. So in case you pay us some insurance, something wrong happens, we'll pay the insurance. So therefore, there were two sides of the companies that were there. On one side was Goldman Sachs Morgan Stanley, and the other side was Credit Suisse, Nomura, Wells Fargo, right? These two. So what happened is, around March 12th, Chinese government gave a ultimatum to all these tech companies to give the data to them around March 12, 2021. So what happened is these Tencent, Baidu, all the Chinese internet stocks, all of them were fined around $70,000 or $75,000 each. Some 16 companies were fined for $75,000 each, which is like a cheap change, right? For a company that is $1 billion company. Say, for example, you have 1,000 units, right? You are asked to pay 0.1 of that unit, which is like nothing for them. So $77,000 was fined for each of these 16 companies. That triggered something called risk management. What is risk management? You got credit risk, you got market risk, you got sovereign risk. So when someone is putting taxes, then a tick box happens. Someone is increasing the taxes, someone is trying to, someone has got some notice from government. All these are sovereign risks. That is the highest form of risk, which all companies have to mitigate. Okay. So in the same land, what happened was the SEC had said that for all the Chinese companies, we want to audit you. We want to look into your numbers. We want to look into everything. And if you don't give, you will be thrown out of the US. So there was this tag happening between two big countries. One is China and one is US. In between, this hedge fund or the index was stuck. So all these companies that were there started saying, okay, I need to figure out how much leverage this guy has so that I can mitigate the risk. That is called credit risk. Because the sovereign is there are two sovereigns that have initiated a action on a particular set of stocks. Immediately, the risk mitigation will start happening. So how much does the guy have? How much does he own? How much does he have to pay? So it came out, according to Don Morris in CNBC, what happened was Credit Suisse started doing every company, every bank has to do this risk management. Okay. So when this risk management happened, then Credit Suisse was the first company that came out and say, hey, man, this guy has 20 leverage with us. What we need to do? And all the five guys, right? Goldman, Morgan, Credit Suisse, Nomura, Wells Fargo, all of them came together and said, okay, let's liquidate the position so that the leverage can come down. So if they did that in a very small fashion, then the storm wouldn't have happened. So in between, there is another law that says that a person, a private entity cannot hold more than 10% of the stock. When ArchegosCapital used the prime brokerages to buy a lot of stock, it increased more than 10%. So obviously, the selling has to happen. So whether the selling has to go very slowly in a controlled fashion or not was what is discussed. Then the next day, the selling started, and on Friday, there is something called block trades. In the dark pool, whoever is trading and whoever is buying, nobody knows. This we know. That's the main purpose of a dark pool. So instead of buying just one trade or one stock or two stock or three units of one stock, what they say is, okay, I am giving you 1 million stock as one unit. So you have to buy all that 1 million at the same time. So like that, Goldman created 50 million worth of single units of these indexes, which has all the stocks of Tencent, Viacom, and all those. or individually Viacom, all these individual stocks, they gave 50 million, 10, 100 million, 50 million block trades to each is these in the dark pool. So people who bought it thought that, okay, we are getting it. The first, it will go, okay, nobody notices. But when people keep on selling, right, then the trigger starts. So a lot of people, as the day started, a lot of people thought that it was another common insider guy who is selling for paying taxes, or in fact, Motley Fool already said that, okay, there is nothing wrong with the companies. Maybe someone is trying to sell the stock for paying tax or something. So people started thinking, okay, maybe that was the case. But as soon as the total trade started happening, $35 billion worth of stock has been sold within 2 or 3 hours. Within 3 hours, the stock started coming down like this, right? In one day, 15% of the company shares vanished. 50%, 20%, 25%. The Viacom stock was around 95, and by the time in 3 days, first day 35 billion, second day 20 billion, third day 15 billion, like that the sale happened. By the time the wholesale, they unwound things, the $85, $95 stock became $35 stock, $40 stock. So that is what has happened. Like you wouldn't imagine this. There cannot be more better script for any movie guy than this. So all these banks put together thought that they will sell it very less and less, and suddenly the banks go to their trading floor and says, dump, sell it all, sell everything you have, whatever you can sell. And therefore the unwinding started happening, and within minutes, within hours, I should say, within hours, the 10 billion vanished like anything of ArchegosCapital. Now this guy is now broke. From 200 million, he went to the level of 10 billion. Now that particular fund is zero. Zero. That is what happened in 2 days. 10 billion to zero in 2 days. Zero in 2 days. So I hope you have learned something with this. And usually the synthetic stocks are not bad, they're good. But the total return swaps and other things, in financial domain, it is called the quick ratio. If everything happens to you suddenly, what do? Is what we all should know. So I hope we'll listen about more about these ArchegosCapital and other restrictions. I think now there will be a law that says, regardless of whether you're private securities or anything, you should give us the report every quarterly, or all people should give all the reports once they cross a particular startup. Maybe, I don't know, I'm just speculating, but this is one such thing. So in span of just 3 months, like January to April, we saw GameStop come from 10 billion to zero. Second one is the Viacom, Tencent, Tiger Index, Tiger Index, that ArchegosCapital Index that came from 10 billion to zero. So I don't know how many hedge funds are in the line again. So people who are actually looking into this thing are now saying that what next, right? There are so many big companies that have become like 8 times, 9 times, 10 times. Who is behind all this? Nobody knows. And I'm sure there is going to be more and more things that we'll be unveiling. So look forward and hope you enjoyed. Next week, we'll talk about something more interesting. Thank you, and you have a wonderful day. Thanks. Bye.